You have a balance sheet that you can look at in your textbook. What I want to talk about is how the different accounts are classified on the balance sheet. What we should know by this point in our career is that the balance sheet consists of assets, liabilities, and owner's equity, or in the case of a corporation, stockholders' equity. And we know our accounting formula looks like this. So on the asset side, we have two categories of assets. We have current assets and we have non-current assets. Current assets are expected to be converted to cash within a year. Common examples of this are cash, accounts receivable, inventory, and prepaid expenses like prepaid insurance and prepaid rent. Non-current assets are typically things we depreciate. Not always, but they're things like buildings, equipment, and vehicles, but they can also include land and long-term investments. On the liability side, we also break our liabilities out into the same two categories, current and non-current. Our current liabilities are liabilities expected to be paid within the next year, whereas the non-current are expected to be paid in more than a year. Examples of current liabilities are things like accounts payable, wages payable, and the current portion of long-term debt. Examples of non-current liabilities are things like car loans, mortgages, bonds payable, long-term notes payable. And I have bonds payable on there twice, so we can eliminate that second one. Finally, our owner's equity for a corporation consists of two pieces. First, we have our contributed capital. This is going to be the stock that we sold. We studied this in detail in Accounting 3. Common stock would be the par value of all the stock the company has issued, and then the additional paid-in capital is the amount of money we received from our stock sales over the par value. The second piece of our stockholders' equity is retained earnings. And retained earnings is simply our accumulated earnings over the entire time that a company has existed, minus any dividends that we've paid out over our history. So our liabilities plus our owner's equity should equal the total of our assets if our balance sheet in fact balances as it should.